recruits start doing the examples. They rappel several times, both off the wall and the helo, and they kind of get that desire to want to do it, and they kind of lose that fear and become more confident. And later on through training, it shows.
Recruits learn rappelling, a controlled slide down a rope that prepares Marines for deployment from helicopters, for navigating difficult terrain, and for gaining access to buildings during raids. From the rappel tower, recruits learn the proper way to brake, regulate speed, and land safely. Rappelling teaches recruits technique as well as confidence and courage in a supervised environment.
You shoot it out your side. That's how you don't friggin' fall down proper. Go that way.
The first inter-platoon contest, held in the first week of the second phase, is termed Initial Drill, where the platoon and junior-most drill instructor are graded as a whole on their performance in close order drill. Every Marine a rifleman is a mantra that is central to the Marine Corps culture. Marines are united by the shared experience of the training they all endure, which is aimed at achieving proficiency as warfighters first. Everything else is secondary. This is another testament to the exceptionality of the Marine Corps, that all Marines are held to the highest of standards. This is Grass Week. The recruits spend time practicing their firing positions, also called snapping in. During Grass Week, a strong emphasis is placed upon firing positions, firing procedures, and safety requirements. It's firing week. The recruits are awakened early in the morning to prepare the rifle range for firing. Half of the platoons will fire at 200, 300, and 500 yards in the standing, sitting, kneeling, and prone positions. The other half will mark targets in the pits. Friday of that week is qualification day, where recruits must qualify with a minimum score.
Good morning, good morning, good morning. Let's start our PT.
Good morning.
All right. We're going to do our 1 minute PT. Get my clock on real quick. And here we go. Run in place. Double jacks. High knees. Touch your toes. Touch your toes. Reach, touch your toes. Reach, touch your toes. Jumping jacks. Jumping jacks. I guess say jumping jacks. Elbows and knees. Push it out, push it out, push it out, push it out. In place. Knees. Jumping jacks. We got done. All right, we got our good morning PT out the way, as always. Make sure you continue to do your PT every day. Step deck is a good tool to use. 3 sets of flutter kicks, 3 sets of what we call them, knees, high knees, and 3 sets of squats, 10, 310. All right, let's get into our first video.
You know, when I was young, I grew up in a fairly strict house, always knowing right from wrong, and for the most part, always been able to decipher what I should or should not be doing. And now that I'm a parent, I realize that having and enforcing a set of rules is an extremely important part to an orderly and functional household. And any trader that wants to make it for the long haul must also have a strict set of rules and make sure we stick to them. Because at the end of the day, what good are rules, even if we break them maybe 2 to 3 times a year? You know, there's nothing worse to me personally than taking a loss in the market that can wipe out weeks or maybe even months of trading. You feel like the last several weeks or months got simply flushed down the toilet. You know, you spend day in, day out grinding out wins, grinding out trades, only to have everything, you know, be wiped out. It can be mentally demoralizing and very hard to get your mind back on reset. You know, it's the financial part of the loss that hurts the most, but the mental and emotional part can be just as bad, because if you're not trading with a free and clear mind, you may as well go home. That's how even some great traders can get caught up in a vicious cycle. Once the losses start, they almost don't know how to get themselves out of it. That's why I think it's so important to try to stick to your rules and limit your losses. You know, one of the great benefits of being a trader is that we're our own boss. We work from home, and for the most part, we answer to nobody. It's really everybody's dream job. But, you know, on the flip side, there's nobody there to hold us accountable. So let's say we all were to work for a company. It doesn't matter whether it's big or small. And 2 to 3 times a year, we bend the rules. Or 2 to 3 times a year, we just make that same mistake over and over again. And we cost this company tens of thousands or possibly hundreds of thousands of dollars. What would that company say to you? You know, most likely you'd be out of a job. That's why it's so important as self-employed individuals, traders, we hold ourselves accountable for our actions. Now, as a trader, I realize the most important thing I can do on a daily basis is preserve my capital. Taking excessive risk, taking on marginal trades, or adding to losing trades is an easy way for losses to add up. You know, sometimes as traders, we're always focusing on the next big setup. How much are we going to make on VERI? How much are we going to make on this? How much did I make last week or last month? But how often we focus on what we're doing poorly? How often we focus on our losses? You know, I think our losses can be a great tool to help us create some rules. I think our losses, you know, can help us study and say, hey, this is what I don't want to do again. This is what I don't want to do in the future. You know, the thing about trading, it's a very tough profession. I think the stats are something like 90 to 95% of traders fail. And why do they fail? They don't fail because of a lack of winning setups or lack of wins. They fail because of their losses. They fail because they just take too many losses too frequently, or just that one big loss. I mean, that's the thing in the market. One loss can wipe you out and end your career. That's where a good set of rules can either make you or break you for the long haul. Now, trading can be a difficult profession. For that, we sit in front of our computers all day long, and we feel unproductive if we're not always in a trade or pushing buttons. You know, we follow traders on Twitter who tweet a new idea or ticker every 35 seconds, and we say, hey, that guy trades 80 to 90 tickers a day. I need to do the same thing. No, I think that's BS. I think you should not do the same thing. I think you need to stick with your high probability setups, the setups you know you're going to be profitable on. I'd say at least 75, 80, hopefully 90% of the time. Now, sometimes it can be hard to sit on your hands and be patient and wait for those setups. But why chase subpar setups? You know, why chase boredom trades? Why put good money after bad? Now, how many of us here of traders have followed a chat room, a Twitter, or a friend into an idea that we knew was not a high probability setup for our own trading style? Now, we all have different trading styles here. What works for you may not work for me. Personally, I'm a terrible long bias trader. If and when I ever do go long, I take profits extremely fast, knowing that a lot of times profits can just get away from me pretty quick. I don't have the patience nor the conviction, you know, to hold them. That's why month after month, year after year, I personally get more strict about the trades that I place. I probably place half the amount of trades I did maybe just 5 years ago, but I make way more money. Why? Because I trade the high probability setups that I know I'm going to be profitable at 80 to 90% of the time. I like to use size with those trades, and I have very strict rules when it comes to cutting losses. Now, I'm sure most of us as traders have rules, or at least we should. How many of us use stops? I mean, stops are a must. I mean, we all have to use stops. Now, I personally rarely use hard stops, but I have mental stops on every position that I take. Basically, if something's breaking support or resistance, I usually just exit that trade. And I think most of us here need to have a mental idea in our head of where we're going to exit a trade based on where it goes against us. How many of us here have ever been in a losing trade and we're down something small, maybe $5,000, and we think, I'm not going to cut it. I feel like this is going to be a winner, and we add to that trade. An hour later, we're down $20,000 to $30,000, and we think, wow, it's hard to, I can't cut it now. We hold it till the afternoon. Maybe tomorrow it gaps up. We're down $70,000, $80,000, $100,000, and we think, what the heck just happened? I could have cut that loss yesterday for 3, 4, 5 grand. Now I've given up 10, maybe 20% of my year just by being stubborn. Think about how much more money we could make at the end of the year if we just stick to some simple rules and cut our losses at an appropriate place. Now, for me personally, I very rarely enter a trade, unless it's with starter size, something really small, unless I know I'm going to be in the money immediately. I asked the question, why would you ever enter a trade knowing it's going to go against you? And you say, well, I'll just add higher. Why would you ever want to do that? I personally like to be right on my first entry. And if I'm not, I cut it and I look for a re-entry. The last thing I want to do, again, is be stubborn, refuse to cut a loss, add to losers, and before you know it, you've given up 10, 20, maybe 30% of your year on any particular setup. I see so many traders that can consistently make money month after month after month, only at the end of the year realize they were stubborn on 3 to 4 tickers, and they gave up, maybe 20 to 30% of the year. Now let's talk about being stubborn for a minute. Why is it that we refuse to cut losses? Is it that sometimes we refuse to be wrong? Or has the research we've done on any particular stock made us so overly biased that we think the market is wrong and we are right? Or did we possibly take on too much size overnight on a low float stock that's opened dramatically against us? There's numerous reasons we take losses in the market, and a majority of them are our fault. We can say, well, Drives was manipulated when it went from 5 to 115. Or, KBIO was a fluke when Shirley bought it and went from 2 to, 40s within a couple days. And those are true. Drives was manipulated, but at the end of the day, nobody forced us to hold Drives, from 40 to 60 to 80 to 100. Nobody forced us to hold KBIO. Some people added after hours. Some people added the net, a few days later. I think at the end of the day, our losses are they're basically our fault. Sure, there can be unexpected news or events, but at the end of the day, I think it's our stubbornness that leads to some of our biggest losses. Now, I personally have a lot of rules in my trading. I've already went over a couple of them. Most of them are just ingrained in my head. I know I'm just like walking, talking, eating, and sleeping. I don't even have to think about them. But I'll go over quick, a couple of my top rules again real quick. I like to trade the best setups out there. So setups that I know I'm going to be profitable on 80 to 90% of the time. And I like to use size with those setups. I ask a question. If you see a setup and you say, hey, 9 out of 10 times I'm going to make money on this setup, why would you not want to put big money behind that trade? Why would you not want to? I think the risk reward is definitely on your side there. I think, for me personally, the big money's and the big wins. I'm not going to get rich scalping. It's just not for me. And I certainly know I'm not going to lose money on boredom trades because I just don't play them. If the setup's not there, I sit on my hands. If not, I'll just leave for the day. I never feel forced to trade. Second, never, ever add to losing trades. There's a reason the trade is going against you. You're wrong. That's all there is to say. You need to exit that trade and look for a re-entry. And don't ever say to yourself, it can't go higher. It can't go higher or it can't go lower. For anybody that says it can't go higher, put a chart of Drives next to your computer from last November. For anybody that says it can't go lower, put a chart of Drives next to your computer from, November 15th to, a few weeks ago. It's down 99.99%. There's a prominent hedge fund manager out there a few years ago that was bullish on Valiant. He was bullish in the 200s, bullish at 180, bullish at 150, bullish at 100, bullish at 80, 60, 40, 20. I think he finally sold at $10 or $15. Why? Just stubbornness. That's all it is to it. It's just stubbornness, in my opinion. Third, take profits on winning trades. I always scale out of positions. Let's say I'm short 50,000 shares of a position and it's reached maybe 70% of my target. I like to take at least a third off right there. Always lock some in. Falls another 10, 15, 20 cents. Take another 10, 15,000 shares off, whatever it is. Don't ever try to be so stubborn to try to pick the exact tops or bottoms. Another one is always trade with a free and clear mind. I've noticed that if I don't sleep well, maybe had a traumatic event in your family, whatever it is, it's just best not to trade. And don't ever trade if you feel obligated or forced to make money. If you had a big loss last week, don't ever revenge trade. You really have to have a free and clear mind to trade in the markets. The biggest one of all, and lastly, is cut losses cut losses, cut losses. I think as traders, if we can create a good list of rules with strict stop loss management, I think at the end of the day, we can become more profitable traders. Thank you.
So basically for us, this boils down to discipline. Being disciplined in what you do in trading is important, extremely important, and it can definitely make or break your profit margin and also your account. All right, let's continue on our education for today.
Will go in this direction within this amount of time. Those are the two variables of our trade. And when we do that successfully and repeatedly, that's how we go about making money with our trading. And so identifying price direction becomes very important in our overall trade analysis. And that's why the first step in our objective trade decision is always identifying the market phase. In other words, we need to know, is price consolidating or is it trending? And we've talked extensively this week on how we go about doing that. And each week we cover this concept in greater and greater detail and in different angles and different ways, because if you can get this down, then you've done literally like 3/4 of the challenge of trading, simply identifying accurately which direction price is currently going. And then with enough time, price ultimately and very likely will go in the direction that you're predicting because you are analyzing it correctly. So mastering step 1 is far more important than mastering step 3, okay? Get step 1 down, and ultimately you can have some error in step 3, which is when you enter your trade, because ultimately with a rollover or different things, ultimately price will eventually go in your direction if you have first accurately identified the market phase or which direction price is going. So we can further do this by utilizing and employing technical indicators to help confirm the information that we're looking at. And we'll talk today and give you some examples of how we go about doing that. We've talked extensively about the RSI, about Bollinger Bands, other trend lines such as the moving average lines, super trend lines, and a lot of the indicators that are available in both Go Liberty as well as in Hourglass. And so today, I want to review an important concept with regards to price patterns, because this is part of the overall picture when we're considering which direction price will go next. You see, when we're looking at the market and we're looking at the wave patterns of price constantly going up and down, and we're identifying, are we in consolidation versus trending? The question is also not only what phase are we in, but when does that phase end? In other words, when do we go from a trending time to maybe back to consolidation, or go from an uptrend to a downtrend? Looking for those transition times where price will reverse and change to another phase is also an important part of our overall trade analysis. I hear from time to time people say, I do really well when I identify the market trend and I'm trading with the trend and I'm winning repeatedly. But then where I start losing is when the trend changes. And that's an important part. So this price pattern that I'd like to share with you today that we have discussed before, but I want to share kind of in a new light, just to make sure that you really understand this clearly, is called divergence. And this is one of the very earliest indications that a trend is changing directions. So let's talk about what that looks like. First is you first have to identify, well, are we in a trend in the first place? And then we'll kind of go into when this trend changes. The first dead giveaway that you are in a trending time is this continuous breakout and retest price patterning. And it's essentially where price breaks above some form of previous resistance. These blue lines on this particular illustration represent our resistance points. These are where the price is pivoting. You can see price comes up, it gets pushed down at that level. That becomes our overhead resistance. That's this new level of resistance. And I'll show you this in our live charts to make sure that this is very clear. So, but as we look at this though, price breaks out, retests. It might retest multiple times. In this case, it did it 3 times before moving on and breaking out above that level again. Here we have essentially another 2 strong retests before breaking out again. We have another 2 strong retests before the trend finally changed. Now, during this time, do we have information besides price that further confirms this information? The answer is yes. Initially, when we had this first breakout, you'll note that the RSI was well above 60%, which is this red dashed line. And in that plot line, this black line, as that is above 60%, that's suggesting there's a lot of upward momentum that is required in order for price to be able to have a breakout in the first place. And so we get that nice breakout to the upside. And whenever price comes back to retest, this is the breakout, retest. At each of those retest moments, I want you to take note of what we see on the RSI reading at each of these contact points. So at each of these points where the arrows are pointing, these are the retest moments. If you look down at the RSI, at each of these highlighted areas with these green arrows, you'll note that each of them is very close to, if not touching, the 50% line. This is a very consistent pattern of measure with the breakout and retest structure in a trending time. So when the market is, we typically see the RSI plot line will come down to the 50% line before then continuing in the upward line, before then continuing in the upward direction. It will also do this in a downtrend. So if this is a breakout to the downside, instead of seeing the plot line kind of between the 50 and the 60%, we'll actually see it kind of down below between the 50% and the 40%. But in each case, the breakout and back up to the 50% line before continuing in the downward direction in the case of a downtrend. And we actually see that kind of over here where we have this lower breakout past this pivot point. What do we get? The plot line comes up to and very close to the 50% line before continuing in the downward direction. And so identifying, first of all, the price pattern, the breakout and retest, combined with a technical indicator confirmation, such as the RSI, can give us a very accurate location for where price is likely going to turn around. Okay, so we have our location, which is at this point of resistance. We have a confirmation of an indicator, such as the 50% point on the RSI, and that can give us a location as well as a confirmed entry reason of when we're going to get into that trade. All right, and just so that you're aware, in tomorrow, we're going to talk all about trade entry reasons. So we're going to further detail about the exact moment that we would push the button in each of these cases. But for today, I really want you to just pay attention to this price action behavior of the breakout and retest. And then we're going to talk about divergence, which is a reversal pattern. So once we've identified that, hey, we're in a trending time, the question is well, when does this trend end? What signs do we have? What signs do we have that we're no longer in an uptrend? And divergence is one of those patterns that we can use in order to identify this. So if we come to our next slide here, divergence is really one of the earliest indications of price reversal. And it can be identified using any momentum oscillator, such as the RSI, the MACD, the stochastics. And in this particular example, we're going to show this. This is kind of a downward divergence. What that means is direction. And then it's going to now change direction and go in the downward direction. So it is a reversal pattern, okay? There are two basic types of normal market divergence. One is called a double peak divergence. The other is called a triple peak divergence. So on a double peak divergence, we're looking at two primary contact points. So price comes up here, and yes, it kind of dilly-dallies a little bit up here, but then it finally gets rejected and then comes back up to retest that same price level. And what we want to see is a change in the momentum at that same price location. So price hit this level initially. Once it got rejected and then came back to that same price level, we have an equal price retest is what we'll call that. The question is price going to continue in the upward direction, or is it price going to continue in the upward direction, or is it going to stop and then go into this downtrend? And how can we know that it will? And so when we compare the RSI reading of the first price, when price first gets to this level, you'll note that the RSI was very high. But as time went on, we see this reduction in momentum. Each of the plot line is just considerably going down, down, down. And then finally, our entry point in a down divergence, whether it's a double or triple peak, is typically at the 60% level. And you'll notice the RSI right to it, and that becomes the moment of entry, predicting that the price would go down from that point. If we're looking at an up divergence, meaning the price had been going down and now we're looking for it to go up, this would basically look the opposite, and the RSI would be below 40%, and our entry point would be at 40% instead of 60%. And I'll show you that in our next slide here. So this is an upward triple peak divergence. So we're going to basically be looking at the opposite side of what we were just considering. So instead of 60% being our entry point, we're looking at 40% as our entry point, because we're going from a downward movement now to a potential upward movement. And so, and the way a triple peak divergence works is we're looking for, as the name implies, three price
Baltimore tank
comparing the three RSI peak levels at the same time. So initially,
I'm just saying. Why are you looking at me? Why are you looking at me? I mean, why are you looking at me? I mean,
we actually don't enter until the third peak of this triple peak divergence. And the signature feature of a triple peak divergence is that the second peak, as you see here, the second price peak is always the longest, always. So if you see three price peaks and they're all basically the same level, that's not a triple peak divergence. You may find divergence in that situation, but you want to understand this specific pattern always has a longer second peak. If it's in the downward direction, such as in this example, it's going to go down further. That's what we mean by longer, is that it's going down further than either of the first or the third price peaks. If this was an upward looking triple peak divergence, it's going to be taller or longer in the upward direction than the first and the third peaks. So as the third peak forms, you'll note that the RSI is reducing in momentum. In this case, it's climbing, but ultimately what that means is that it's losing the downward momentum. The RSI indicator is a measure of strength or momentum, but it's with a directional implication, meaning that as the plot line is below 50%, that's suggesting that there is downward momentum or downward strength. If the plot line is above 50%, it's suggesting that there is upward momentum or upward strength. And so it's the 50% line, the middle of the RSI, has the 0 point on the measurement scale. And again, if it's above 50%, that means there's upward momentum. If it's below 50%, there's downward momentum. And so the further down it is, the stronger the momentum. So you can see here, this first peak, the RSI is well below 40%. So there's a lot of downward momentum, and we get another nice downward move of the price. But we begin to see that, and it's a little bit hard to see on this particular example, but there's actually a reduction in momentum. It's subtle, but there is a slight reduction in momentum. But our entry point is not at the second peak. And that's why this pattern is so powerful, is we're actually waiting for the third RSI peak. And so price gets rejected once again, and it finally comes back down. And as it does, our entry level that we're targeting is right around the 40% level, and we're looking for price to then reverse and go in the upward direction. This particular price action pattern is indicated all of the major, most significant moves in the market's history. So if you looked at the NASDAQ, if you looked at the Dow, all of the major market indicators out there, you will actually find this exact pattern on all the high time frame charts. And so, but the key take home message here is to note the 40% and the 60% as your entry point on that third peak. If you're looking at a triple peak divergence, or if you're looking at a double peak divergence, it's at the equal price retest, so the same level. It's kind of comparing apples to apples. If these two price points are at different levels, meaning if the price is well below or well above, you can't really compare them quite as easily. All right. And so for a double peak divergence, look for the same equal price retest and a reduction in momentum. Either it'll look downward if it's from a top position, like as in this example, or if you're looking at an upward divergence, you're going to see the reduction, meaning that the RSI is essentially climbing back closer to the 50% line. That's what you're going to see. And so as we look at these different price patterns for reversals, this becomes part of the overall picture and analysis, meaning we're comparing price action and market structure, looking at these pivot points, but we're also combining a technical indicator such as the RSI. You can do this with the MACD and stochastics as well, as I mentioned previously. The RSI is kind of nice because we have these key levels at the 60 and 40 that you can use as a preemptive moment of entry. Because in this example, for just to illustrate this point, at that moment, if we were to place our trade at the moment that the RSI is at 40% in this triple peak divergence, it is the last and final moment where price then moves into an uptrend and never returns. It's the furthest point that we could have entered into this trade, the best place we could enter this trade before this new trend starts. So normal Forex, that's really important because you're trying to catch the beginning of a trend. And but with what we're doing with HFX, we don't need to be in the trade for that long, but it's still a phenomenal entry point because it's indicating that the price is going to go in the upward direction, as in this example, or in the downward direction of a peak divergence. So that is the two price behaviors and patterns that we can utilize in conjunction with other things we discussed in order to identify which direction the price is going to go. And to identify, is a trend going to change? Because the reality is that no market phase stays the same forever. So now let's jump over to the live charts and let's look at some further examples and talk about how we then can identify these changes in market phase and so forth. So some of the examples that I just gave you were actually from this morning. And this is an important point because the take-home message is that we don't need to cherry pick our examples. These kinds of patterns happen every single day. That first example of our double peak divergence happened this was kind of during the London session. Here it is right here. So we had this nice long uptrend of price movement. And then we had our nice divergence at the very, very top. And we'll draw these lines in here just real quick so that you can see. So here's our equal price retest, our flat top. And right before the trend changes and pretty much never comes back to look at this nice new downtrend, what do we see? Here is where that divergence forms. So here's our divergence forms. So here's our first RSI peak, our second one, right at the 60%. That becomes our target entry point. Why? Because ultimately, and I'll kind of zoom this out so you can see this a little bit more clearly. What you're looking for is price to come up to a level for the RSI to be above 60% on that first time. And as price gets rejected and it comes back up to try and push through that again, we want to see a reduction in that momentum. So this right here becomes that point of interest. That becomes the key entry position, is at that moment there. Now, a couple of things you can implement if you want a specific objective trade entry reason is you could wait for a candlestick pattern. We'll go into more details on this later, but ultimately, just to kind of zoom in and show you how this would work, if you wanted an objective trade entry reason, you could wait for further confirmation. Candlestick pattern, for example. In this case, we're projecting that based on this downward divergence, okay, we went from an uptrend where a divergence is a reversal pattern. So we're projecting or predicting that price is now going to go in the downward direction, right? So we're looking for put options at this point, but we want a confirmation. So do we get one at this level here? Okay, I'm going to eliminate some of our drawings so that this is very clear. We're going to zoom way in on this. All right. One of the patterns that we get is what's called a bearish engulfing candle. So again, here's our entry point here. There's our RSI reading right at the 60%. You'll note that we get a bearish engulfing candle. A bearish engulfing candle just simply means that this red candle here is much larger. The entire body of that candle is much larger than this previous green candle. Bearish implies downward movement or downward momentum. So so price comes up to that key level and we have a downward bearish engulfing candle. That's a great indicator at a key level. Okay, we've already had our divergence form, and so we're getting this sign at this important location. This is important because sometimes people make the mistake. They just say, well, I'll just trade every engulfing candle that I see. That's not necessarily a good idea. For example, right here we have a bearish engulfing candle. Right here, we have a bullish engulfing candle. And in each of these cases, it doesn't really produce much directional movement. So getting a specific candlestick pattern at a key level is far more useful than just looking for those candlestick patterns in general or at random, okay? So once we get that, at that point, you could place your trade. If we applied our 3-candle rule, it'd be 1, 2, 3 candles. We're clearly in profit on a put option at that point, and we would win that trade. So that's one example of how we could actually make an objective trade entry decision based on a specific price reversal pattern. All right. So in addition to that, we have other things we can look at. So let's zoom back out and let's look at that triple peak divergence. Reset our chart here. Zoom back out. So here we have a nice downtrend. Price is just moving considerably in the downward direction during this entire time. And so when will this trend change? This is the big question, is when is this trend going to change? All of a sudden we get our triple peak divergence. Because if we just zoom way out, I want you to see kind of the two trends clearly. Initially, we had our nice uptrend here. There was our big uptrend movement, where we have a nice downtrend secondarily to that. And then also we get this big uptrend. So everybody says, well, man, I'd love to catch these trends. I'd love to get in on these opportunities. How do I see them? Well, we already identified, here's our double peak divergence at the very top of this uptrend that turned into this nice downward trend. Well, right here at the bottom of this downtrend, this is where we get that triple peak divergence. So let's zoom back in and let's see what this actually looks like in detail. And I'm going to take off our Bollinger Bands. We don't really need those for this specific strategy or this particular pattern. But you'll note this is where it starts. So here's the bottom of our trend. And as price pushes down to the downside, once again, we see the RSI is very low, below that 40%. Bounces up, gets pushed down further. The RSI is still below 40%. But if we actually put a line, and I'll expand this just to illustrate this. If we put a horizontal line at the very peak of that RSI reading, and we put a horizontal line at the peak of this one, you'll note that there is a reduction in downward momentum. It is not significant. There is a reduction. Okay, that's kind of our first and earliest sign that this downward trend that we were watching before might be losing its downward momentum. But we don't rely exclusively on that. We're looking for a third peak and a further significant drop or change in the downward momentum that we were looking at. And so as we see price get rejected again, all right, each of these times where price changes direction, we refer to that commonly as a rejection. And as price pushes down once again, it oftentimes is at a very similar level to our first peak. Note that these two peaks are at a very similar level. And once again, what are we looking for in the RSI? We're looking for, because this is going from a downtrend, downward movement, potentially to an uptrend movement, we're looking for an RSI reading of 40%. We see that here at this point. So that becomes our location of entry. Now, we can also apply a candlestick pattern to further confirm that there is that rejection at that point. And so if we delete some of these drawings and we zoom in, do we get a candlestick pattern at that moment? Yes, we do. So if we zoom in on this, here is our third price peak. And what do we get? A nice bullish engulfing candle. Note that the green candle, the whole body is much larger. It engulfs the entire previous red candle. That is what we refer to as a bullish engulfing candle. We also affectionately call that a confirmation candle because it's one candle in the direction that we think price is going to go based upon the data or the evidence that we have in front of us. So we have our nice triple peak divergence. And so it's always a good idea to, in a sense, draw a line between these three peaks. So here's our first one, here's our second, and then there is our third. Now, it's okay that this second peak pushes through this a little bit, as long as it is reducing, that follows the correct pattern. But we do wait for that final entry moment when we see that the RSI is very close to it. Sometimes it's a little bit inside, sometimes it's a hair beyond, but ultimately we want to see that RSI very close to 40%. Or if it's in a downward version, we want to look for an entry right around 60%. So that becomes kind of our key entry point. Had we entered in at the close of that candle, this green candle here, our 3-candle rule, 1, 2, 3, price closes above our entry point. And the great thing about HFX is that we didn't need price to move very far. In a few short candles, we didn't need price to be that far along in this new trend direction. But having said that, again, because our primary step one is to identify price direction, not only are we predicting price direction for this short-term move that we just took right here, but we're also looking at where the new trend direction is going to go, right? And so if we zoom back out, if we reset our chart here, well, let's zoom this back out so this looks a little bit more clear. So this was our entry moment right here. This was our entry moment right here. And that became the beginning of a new long uptrend. And so from that point forward, what are we looking for? If we know that we have this triple peak upward divergence, we could potentially be looking for call options from this moment forward until we see some other evidence suggesting that the trend is going to turn into a downtrend. So again, if our first question is which direction is price going to go, this can be a very useful indication. In addition to breakout and retest, which we definitely see here, if we begin to keep track of our pivot points, here's a pivot point here. that was indicated, not just in hindsight here, mind you. Let me zoom in and make sure that this is clear to you. Once we got this indication, again, we're always keeping track of our market pivot points. And so price came up, but then it started to come back down. That's what indicated that this was some form of overhead resistance. And then what did price do? It pushed on through. Once price pushes on through, that's our breakout moment. We're likely going to get a retest. And where are those retest moments? Repeatedly, we see it here. It's all at our resistance point level with a corresponding RSI reading of 50%. We get done on each of those examples, okay? You don't have to look that hard. You do have to be a little bit of patience. There are multiple candles that will go by before you have these trade opportunities. But when you see these are very, very clear and highly, highly accurate, okay? As far as when we actually get in the trade and the accuracy of win rate with these specific patterns. So we had our our breakout, and so we get our retest moments. There's 3 trade opportunities right in that moment there, and then price breaks out again to the upside. So we have another overhead resistance level at that level, and then we can look for, once again, where does price retest to? At that same previous pivot point, because it was acting as a ceiling, but once it breaks through that point, all right, it's likely going to come back to it, and that previous ceiling is now going to act like a floor. So it bounces off it a couple of times. We have multiple opportunities. You can see down here where the RSI once again hits that 50% line and then continues in the upward direction. So we could have taken both of those trade opportunities where we have a retest and a corresponding confirmed RSI reading of 50%. And so we just do that as long as the trend continues. We have 2 more opportunities here. Why? Because, click off of that, because we have, once again, these 2 pivot points here become our new overhead resistance. And so if we have a breakout to the upside, what are we likely to have? A retest, and then a continuation. All right. So we just simply follow that pattern until the evidence suggests otherwise. Sometimes that's divergence. Other times we can use even the Bollinger Bands. If we add our Bollinger Bands to our chart, one of the further indications is when we see, grab my brush tool here, when we see price push down through our middle moving average line. So here we push to the underside, and then it comes to this level. So at this point in time, if you're looking at this moment here, what's really going on here? Do we have any new data that would suggest that we're still in our uptrend? Reality is we pushed down below this previous resistance point. Let's delete some of these indicators or drawings and add just a couple new ones here. So here was our previous level of resistance, and also it pushes down to that, bounces off of it and pushes down. So this now is an overhead ceiling. And what do we see on the RSI? If we look down at the RSI, now the plot line, instead of being above our 50% line, as it is in all of this previous activity here, now the RSI has moved to the lower side. And remember that anything below the 50% line is suggesting that there is downward momentum. Any plot line activity above 50% is suggesting that there's upward momentum. So for right now, based on current data, we have a breakout to the downside, a retest up to this level. We have our corresponding RSI reading right at 50%. So we could take this trade for a put option. But note that we were just simply keeping track of when is the trend changing, and then confirming that with a technical indicator such as the RSI and such as the Bollinger Band. Each of these tools are available within the IM services. And if you're using Cash Trap, you can add an arrow to this picture. That can become your final trade entry reason. In other words, you can look at that price action behavior, look at your RSI reading, look at any other indicator that you may be using, such as the Bollinger Band, and then you look for an arrow. You can also use the point system. That is, he does that a lot as well. But just to give you a quick example here we have price on USD CAD. Here's our pair. Change this color red. Let me make sure this is nice and thick so you guys can see this. So here we're on USD CAD. Price pushes down through these middle moving average lines. This is on a 5-minute chart, but these principles are universal. So what are we likely going to get? We have a breakout to the downside. We're likely going to get a retest moment. And so we're looking for a down arrow at this point. We're looking for a down arrow to further confirm this trade opportunity. And at each of these breakout retests, okay, we're looking for down arrows. So we're looking at price structure, or we're looking for these breakout retest kind of moments here. Now, the RSI and stochastic settings on within Hourglass are slightly different. And so the way they're designed to be used is you're looking for, in a downtrend, you're looking for these cross downs of the plot line down through the red dash line. So that can be additional information. You don't have to wait for that to occur, but that can be one form of additional evidence suggesting that the price is then going to be continuing in that downtrend. If you're in an uptrend, you want to look for the cross up through the green dash line. All right. Again, the settings on the stochastics and RSI within Hourglass are different than what we're seeing here on our TradingView account. And so you utilize these in a slightly different way. Again, you're looking for these plot line crossovers through the red dash line, down through it in a downtrend, or up through it in an uptrend, confirming that price is continuing in that given trend direction. But we also want to keep track of these resistance points. We're looking at where is price breaking out to, where is it retesting to, and where is price likely going to continue to go. If we're in a trending time, we want to trade with the trend. There's a common expression in trading called the trend is your friend. It's because given enough time, price is likely going to move in your favor rather than against you. All right, that's how we apply that. So, so directly within Cash Trap, you can apply these principles. You can do the same in Go Liberty, utilizing the simple scalper. Here's a similar opportunity here on the GBP to USD. Let's draw this out for you. So if you're looking at the pound to US dollar, we have a similar opportunity. Here we had a nice strong uptrend move, and then price crosses down through this middle moving average line. And so as price comes back up to retest that level, what are we looking for? Either a confirmation candle, a bearish engulfing candle, something like that, or a cross down of these stochastics and RSI lines through the red dash line, confirming that price is now going to move in the downward direction. We get that at this moment here. Okay, so we could look at that as a potential trade opportunity. We can also preempt it and enter literally, when price gets up to that level. That'd be another way that you could approach that. But ultimately, keeping track of which direction is price going to go, we have to keep track of trend direction. And so just noting the basic price action behavior really is that foundation that you utilize on a daily basis that really never changes. If people say, does this work on other things? Let's come in here. We'll delete these drawings for a second. And right now we're looking at gold, which is a commodity. If we pulled up the euro dollar, which is a currency pair, we're going to see the same kind of patterns. All right. For example, right here. All right. For example, right here, price was trending upward through our middle moving average line, and so and so as it does so, and it comes back up to that level, then we can look for a potential downward move. Right. If we wanted to look at an index, okay, index is different than a currency pair. So let's look at US 30, which is the Dow. Once again, we're looking at all the market pivot points. And what do we see? All the market pivot points. And what do we see? Here we have a nice trending time. The price breaks out to the downside. Here's our previous resistance level. So we have a breakout to the downside. As this is coming up to retest, we're looking for to retest either to that price level or oftentimes to the middle moving average line. And we'll go into this on a separate video, but typically you're going to get a retest either to the 50% line, as we mentioned previously, as you see on this particular opportunity here, or it's going to be below in the case of a downtrend. And oftentimes it'll actually be right down at the 40% with these particular cases and examples here. All right, so you'll see both of those kind of opportunities. But in either case, we're looking at that same basic price behavior. Breakout, retest, breakout, and retest. This is a repeatable pattern no matter what you're trading. But what about stocks, Josh? Does this work on stocks? Now, you and I mostly are not trading stocks, but it's important for you to understand that these are universal principles that apply to every aspect of the market. Why is that important? Because ultimately, if it applies to everything, that means it's not just based on luck, based on chance, or a strategy that's going to disappear tomorrow. These are principles that you could go back to the very beginning when charts were, when price was beginning to be tracked, and you'll see the same behavior. Now, so why are stocks important in this picture? Because people sometimes make the argument, they say, well, But isn't stocks based on fundamental analysis, based on the company, based on the CEO, based on market sentiment? People think that I just brought up Apple here, famous company. Shouldn't its price behavior be based on what people believe is going to happen with Apple? Well, here, just glancing at Apple on the 1 minute time frame chart, what do we begin to see? Here's some beautiful price action, normal price action behavior. Look at these pivot points: breakout, retest, breakout, retest. This happens over and over and over again. And so all the RSI readings, you can identify divergence, all of these kind of things. In fact, here's a nice divergent moment here. Here's double peak divergence. Price comes back up to this level. We see a reduction in the RSI momentum from this first to the second peak. And what do we get? Nice downward move. How is that possible? If this stock, if Apple is based purely on people's belief and market sentiment and all that, then why is it following these consistent price behaviors? And the reality is that these are universal principles that apply to any chart on any financial instrument that you want to trade. Whether it's a foreign currency, whether it's the stock market, indexes, commodities, oil, it does not matter what it is. These principles are universal. All right. And big surprise, after we had that beautiful divergence on Apple, what has price done ever since? It's done nothing but go down. So again, these principles are extremely powerful, and if you'll learn them and apply them, you can begin to make highly accurate price direction predictions. And why is that important? Because that's how we make money. That's how we make money in HFX, is making an accurate price direction prediction, and then we simply apply a time expiration. Now, when we talk about our specific trade entry reasons tomorrow on Thursday, we're going to talk very detailed about what kind of time expiration we utilize with our trades. Because there are variables that are involved that determine how long of a trade you take. You can make a basic prediction, but be wrong on your time expiration. In other words, if I looked at the chart, and if we asked anybody on the street, we said, you probably heard Apple, big company, popular company. They do great products. Both Brandon and I use Apple computers. Many people do. Is it a good company? Sure, it's a good company. Which direction is their price going? Oh, it's definitely going up. Well, they may be correct, and I could tell them at the exact same time, actually, the price is going down. And both of us could actually be making a correct statement because the assumption is dependent upon time. In other words, they may be thinking, well, over time, over the next year, over the next 2 years, Apple's price likely is going to continue to go upward. But what I was referring to when I say price is going down is I'm saying, hey, over the next 15, 20 minutes, price is going down based upon my technical analysis. And so both of us can actually be correct because what we're considering is a different time frame. And so that's how we go about making money with this business, is that we're looking at a specific time frame. They could be correct in their overall assumption that Apple price is going up, but maybe the amount of time that they need for it to go up is the next 6 weeks. For me, my prediction, when I say price is going to go down, it was maybe based on the next 20 minutes. You see what I'm saying? So when we apply time expiration to our trades, the amount of time that we assign to those trades is important. And the exact moment when we get in the trade is also important, especially if we are going to do a very short-term time frame trade, 1, 2, 3, 5 minutes long. You got to be pretty precise on your entry timing so that it almost immediately begins to go in the direction that you're predicting. So, but by utilizing some of these price action behaviors and so forth, we can begin to make those highly accurate market price direction predictions. And so, and further proof of that and evidence of that, we're kind of an evidence-based team here. We're really focused on what actually is repeatable for the entire field. If Brandon and I are the only people winning at this, then we're failing. Because ultimately, if you guys are not winning, then what's the point of you being involved in this business, right? And so we want you to be able to repeat what we're teaching here. Not that you need to go out and teach, but if you can apply these principles and go out and actually win, then that, for us, that's a success. And so that's why we do these flyers on a daily basis, is because we want to provide the further evidence, the proof that these concepts are repeatable out, and that anybody, whether you're rich, poor, whether you're old or young, whatever you may be, whatever background you may come from, whatever country you may be from, it does not matter your circumstance. If you apply these principles accurately and with some knowledge and experience, ultimately you can produce the same consistent results that we are experiencing, that other people are experiencing. And that's why you see these 70, 80, 90% win rate. You'll see people get 100% win rate out of 10, 20, 30 trades in a row. How do they do that? It's because they're accurately applying the principles that we're teaching. So just as we wrap this up, again, take this message home. If you want to decrease the risk in your trading, if it feels risky, if you ask in your heart of heart, you say, do I feel this is risky? Ultimately, increase your knowledge, increase your experience. That means practice, practice, practice with a tiny amount. Even if you're trading with $1, get that knowledge, get that experience and practice, and ultimately your overall relative risk will decrease dramatically. You'll find that your win rate increases and your profitability increases as well. Thanks so much for being with us today. And with that, Brandon, I'll turn the
Okay. Let you guys unmute yourselves. All right. Does anybody want to share their screen, ask any questions? I want to share one quick thing real quick, and then we'll go ahead and open it up for open discussion and also marking up charts, any questions you have, things like that. What I want to cover is this. I don't necessarily use indicators. However, I think the RSI can really help me predict the market, but I want to show you something different. It's called the head and shoulders pattern. Okay, so the head and shoulder patterns look like this. Let me draw it out. This is called the regular head and shoulder. Okay, what is that also called? You also see 3 peaks. So he just taught you guys about the 3 peaks. Well, I use what's called the head and shoulders pattern. And with the head and shoulders pattern, basically I would sell this off the right shoulder. Let me show you something else. Let me get my tool here. There we go. So I would buy off the right shoulder there. I'm sorry, sell off the market right there. I keep saying buy. I will sell the right shoulder with a regular head and shoulder pattern. And then with inverted, it's the opposite way. So with an inverted head and shoulder, you buy off the right shoulder. I know what I'm saying, but I'm saying the wrong thing, right? I need some coffee this morning. So I would buy off the right shoulder just like that. So the same thing he just showed you guys without the RSI. So if you see these patterns, this is the #1 reversal pattern in the market. It's called the head and shoulders pattern. So you can look for these on any chart. Okay, you can kind of see one right in there, right? You can see the peak come down there, right? See the same thing. Okay, so does anybody want to share their screen, ask any questions real quick?
I have to use my phone this morning. I'm not sure what's going on with the Zoom on my laptop. The speaker is not working. So I can't share my screen, but this morning has been extremely rough. It didn't work out that bad in the end because of exactly what he said in that video just now, when trend is your friend.
Mm-hmm.
So I was doing some chart markups this morning. I'm going to post the latest one in the chat after the call. That one I actually rolled 4 times because I was like, this is going to go down. It has to go down. We are in a downtrend. It's going to go down. And I just rolled it and I cleared. And well, because of the roll, I'm in a lot of profits, right?
Yeah.
But it was rough this morning. I was like, oh my gosh, am I getting too saturated? I feel like if I have too many lines on my chart, maybe I'm getting confused. I don't know. This morning I felt a little rough this morning.
Yeah. Well, what I'm gonna even try to do, like you said, clear my chart a little bit, and I'm gonna focus on drawing more zones and using more things like head and shoulders pattern, things like that, and just practice in a demo account or practice with $1, like he even said on the screen. But we've been saying that since the beginning of boot camp. Let's do a demo. Let's do $1 trades. Get to practice your strategy. But yeah, definitely clearing the space, clearing the airways out a little bit may help you see things a little bit better. And
well, I've actually been doing my demo trades, all my chart marks up. I've been doing it on a demo account, not my real account.
Okay. That's good to hear. Okay.
Yeah.
That's great. So anybody else want to share their screen and show and go over anything, mark some charts up, or anything you might want to cover? Well, we got a few more minutes left in the in our session here. All right. If not, I'm gonna look at a couple of pairs, see if I see anything with the head and shoulders. Okay. So we have a couple things going on here. There's a big pattern there. You see the reversal here. This is GJ. Make that a little bigger. Get my pattern out. Matter of fact, let me start that. See it. Hold on. Okay, you can't really see it because it's so small, but I just wanted to show you the pattern that it definitely is doing exactly what he just described. 3 peaks. Right? You guys see that? So you got 1, 2, 3 peaks, and then you got that downward momentum, like he was saying on the video. So this does work. You just have to watch and watch for it, and basically know when to enter it. So basically, you would enter here at that 3rd peak, and you were going for the sell. And you can look for that sometime. If you see it, you're not going to see it all the time, but most of the time, you're going to see a reversal pattern that will help you make a decision on when to take a trade or not in the opposite way. But I like using the break and retest a lot. When that's mostly used when the market is trending. When it's consolidating, I just go from the top zone to the bottom zone. See if I see anything else for that. EU did the same thing. There's 3 peaks right there. There's one here. 2. And there's your 3rd peak there. Then the market went down. All right, so there's that one. Let's go to UJ. Just trying to identify these things to see if it really is facts so we can see it. Can you really see 3 peaks? I see 1. Come on. 2. There's the 3rd one. And then there's the big downtrend. So I kind of identify these things with my naked eye. But again, if you want to practice this or just start using arrows and lines, that can help you to start visualizing this stuff, and then just take time out your day to just look at charts and see when you see the price change directions, look at the candles, look and see what's going on. And then you see it again over time. It's okay, now I know I can take a trade. So basically, again, it just comes down to practice and just looking at charts all day long. Well, not all day. I'm just saying in your time. Let me not say all day because I don't do it all day long. There's 3 picks again. 1, 2, 3. And then you see, move my line. 3 peaks. And then we get our reversal.
I have a question.
Yep.
So in an instance like this, right? Because if you're watching the market live, you mightn't really notice that it was the 3rd peak until, well, the market starts to go down, right?
Yeah.
So do you get in? So let's say the first red candle, after that green candle at the top of the across. Yeah, so that first small red candle, and then the second red candle where it starts to reverse. Like if you get in right where your red line is to go down, do you think that's a good idea, or no, you should always get it at the top?
Well, yeah, I would go for the highest point, but that way, if it comes back up, you have a more chance of winning that, clearing that trade.
Yeah.
I would have got in up here, or yeah, because I have a zone here. So I got like 4 lines there, right? So that's really a zone. So as long as the price comes into that's the way I trade. I trade off the zones.
Right.
So instead of having all these lines, I'm gonna just strictly use my zones from now on. So if my price comes into my zone, anywhere in that zone, I know I can take my trade and I'll be okay.
Right.
Yeah, because for me, zones work better than just a horizontal line because it gives you a little more leeway and also to take in consideration of the wicks. So see that line, the red line is there, but if I put a zone here, I can cover the wick as well. Let me just show you that. See, now I can cover my wick and my body of the candle. So it's like a range. And it works out for me pretty good. So I try to stick to that. Yeah. Anybody else have any questions? Okay, I'll just keep looking. We're just looking for some quick reversals real quick. Just to see what happens. So even in this situation, I can see 3 peaks right away. So you got 1, 2, 3, and then finally the market dropped down. So they don't necessarily have to be like right next to each other, but just a peak. So this could be a peak, one over here, and then your third one here, and that's when you take your sell. Actually, the market came all the way up to this red line, as a matter of fact. So that could be, your peak, but that's a crazy wick right there. So I would not. You can't predict this. This just happens. So that's not even normal. See something like that. So let's be realistic here. I probably would not have caught that. So that was like a whoa, look what just happened kind of moment. That's doing the same thing. So I'm just looking for something real quick to see if I see anything that stands out for what we're talking about today. If we see the reversal before it happened, like right here is the reversal. So let's look back to see do we see any peaks or anything, or any head and shoulder pattern. Okay, so again, the head and shoulder pattern does not have to be right next to each other, but you can see the pattern. So you guys see the peaks right there? One here. And again, this is just my naked eye. I didn't use anything, just looking for the peaks, just to be able to identify the peaks and say, okay, let me look a little closer and see what happened. So you got 3 peaks there, and then finally you got your flat tops, your flat bottoms, and then it goes back the other way. So just take time out your day-to-day to kind of look for these things, use the arrows, use the head and shoulder pattern to help you identify these things, and just kind of visualize where these patterns are going. Then when you go to your live trading today, utilize this today. So I see 3 peaks. Okay, boom, I know it's going the other way. Use the break and retest strategy. Use your zones. But again, just remind you guys to put your chart markups there. Try to mark up at least 5 charts a day. Doing your demo practice trading. Place all that stuff in the chart markup group. We are at day number 8. So we're moving right along in this boot camp thing. Hope you guys are getting some value out of it. And we'll see you guys tomorrow.
Thanks, Vaughn.
All right, no problem. Yeah.
Tomorrow we have a sales meeting with our VP, so I will be able to, so I'm out tomorrow.
Okay, you kind of sounded like a robot, but I got the end that you won't be able to be in the boot camp tomorrow.
Yes.
No problem. Thanks for letting me know.
All right, cool. No problem.
All right, have a blessed day.
You too.
All right.
Bye-bye.
Bye-bye.